My name's Andrew Hallam. I'm the author of Millionaire Teacher and Millionaire Expat. What I want to talk to you today about is market timing. And the reason I bring this up today is because I think more than ever, or at least more than ever is probably exaggerating a bit here, but when the markets drop considerably, such as what we're seeing right now at the beginning of 2020, whenever we have periods where markets drop, so many investors who claimed initially to have this steadfast plan to follow through with their portfolio of low-cost ETFs, contribute to that portfolio on a monthly basis through thick and thin. They're going to be able to handle it. So many of them capitulate. So many of them start freaking out. So many of them start contacting people like me and asking me, so how should I move my money to protect it? Should I start investing everything into value ETFs? Should I stick everything in oil? Should I buy gold ETFs? Should I suddenly swing my entire portfolio into bonds? This is one of the reasons why investing is incredibly simple but difficult. And few people really recognize how emotionally difficult it is until something adverse happens to their investment portfolio. So let's talk about the portfolio, or at least let's talk about the markets as 2020, at least during the first few months of 2020. We've seen the U.S. stock market drop as of March 20th, 2020. U.S. stock markets dropped about 29%. If you have a globally diversified portfolio of ETFs, let's assume that you have 60% stocks and 40% bonds, you have dropped about 21%. If it's globally diversified, you have an international stock component and a US component, you probably dropped about 23% so far from January 1st to 2020 to March 20th, 2020. So you probably dropped somewhere between the margin of 21% down and 23% down. And many of you are asking yourself, well, shouldn't I have known what the whole coronavirus thing? We knew what was happening in China. Shouldn't I have pulled that money? Shouldn't I have listened to other people? Shouldn't I start now to listen to the news to see if I can get great investment guidance? Can't I now tweak my portfolio to see if somehow I can mitigate the drops or the losses in my personal account? The key here is to ignore market forecasts, maintain a constant allocation, continue to add money if you have an income, stay calm, and carry on. Let me give you an example of tactical asset allocation funds. Now, these funds have fund managers at the helm who can move their allocation as they see fit. So, if the coronavirus news hits in January 2020, they see or believe that the US markets and the global markets are going to fall. What they could feasibly do, if it's a tactical asset allocation fund, is they could sell all of their stocks and put everything into cash. So they're not confined to, say, a certain parameter whereby they have to maintain a balanced allocation. They don't have to maintain an allocation of growth stocks or value stocks. They can do whatever they want. They can pour everything into oil stocks if they want. They can mix things up, put lots into cash. This year, put lots into bonds. That's why it's called a tactical asset allocation fund. And they're run by really smart people. In 2018, I wrote a story called Why Your Investment Portfolio is Like a Bar of Soap. Morningstar tracks 308 US-based tactical asset allocation funds. The people that run these funds are incredibly smart. They have their fingers on the economy, global interest rates, earnings projections. These are some of the brightest fund managers in the world. But it's incredibly difficult to time the market and to see the future. So out of the 308 tactical asset allocation funds that Morningstar had tracked, there were only 182 of them with 5-year track records. And what I found was when looking at those with 5-year track records, only 1, 2, 3, 4, 5, 6, 7, 8 of them, only 8 of those 182 funds with 5-year track records actually ended up beating an index portfolio of 60% stocks and 40% bonds. So a balanced, which would be 60-40 allocation in ETFs during that same 5-year time period would have earned a compound annual return of 8.75% per year. The vast majority of those tactical asset allocation funds drastically underperformed that. The best one, of course, 8 of them outperformed that. 8 of them beat 8.75% through their tactical maneuvering. The 8 that outperformed it, I'll just give you an idea of which one did the best. It was called Cavalier Growth Opportunities Institutional Fund. It averaged a compound annual return of 11.01% per year compared to the 8.75% for the balanced stock market index, 60% stocks, 40% bonds. So you might wonder, if it was so easy to predict the stock market drop if you had your finger on the economy, then the tactical asset allocation funds should have performed really well between January 1st and March 20th, 2020. You'd think that they would put everything into cash. Well, that's not actually how it turned out. I'm not going to cherry pick and look at the worst tactical asset allocation funds of the 308 or out of the 182 that have 5-year track records. I'm only going to look at the 8 that beat a balanced stock market index over that 5-year period ending midway through 2018 when I wrote that article, Your Investment Portfolio is Like a Bar of Soap. So when I look at the performance of those tactical asset allocation funds, those 8 winners, here's what I find. On average, they underperformed a globally diversified portfolio of stock and bond market ETFs. Not only did they underperform it, but they got hammered by it. I'm just going to give you an example here. As I'm sitting here, your portfolio, if it's balanced from January 1st to March 20th, 2020, if it's balanced with stocks and bonds, say 60% stocks and 40% bonds, you would be down somewhere in the margin of, say, negative 21% to, say, minus 23, maybe minus 24%. That's about it. The tactical asset allocation funds. These were the ones with the best previous 5-year track records. First one is down 32.43%. Next one down 30.48%. Negative 26.34. Negative 30.43. Negative 22.39. About the same as a globally balanced portfolio of ETFs. Only one of them actually would have outperformed a diversified global portfolio of ETFs, 60% stocks, 40% bonds, and that would have been the Standian Tactical Growth I Fund, US ticker symbol ETFOX. It's down just 17.57%. Now here's what we do know. Going forward, your investment portfolio, if it's globally diversified, low cost, you're not messing with it, you're not going to try and guess where the markets are going to go, stock markets, bond markets, you're not going to pull out into cash at some tactical time. Chances are you're going to actually end up beating that fund too over the next 5 years. So what's the moral of the story here? The moral of the story is that professionals do not, on aggregate, come anywhere close to beating a return of a globally diversified portfolio of ETFs. Do not try to tactically move your money around based on what you think or what someone else in the media is trying to tell you. The people running these tactical asset allocation funds are full-time professionals with their fingers on the pulse of the economy, and it's likely that if you're a boglehead investor, you've already, over the past 3 months, these devastating 3 months, you've already beaten them. Thanks very much. I hope this was helpful.